Welcome back to the COO's office. We are nearing the end of our rigorous selection process. We have found a promising industry. We have analyzed the financial health of a specific company. We have even vetted the CEO and management team to ensure they are honest and capable. You might think you are ready to buy. You might think this company is the one. But love makes you blind. And in investing, blindness is fatal. You might have found a great runner. He runs the 100-meter dash in 10 seconds. That sounds fast. You are impressed. But what if the runner in the next lane runs it in 9.5 seconds? Suddenly, your great runner is actually the loser. In the stock market, everything is relative. A company is never good or bad in isolation. It is only good or bad compared to its rivals. Today, we are going to perform the final stress test. We are going to discuss how to conduct competitor analysis. We are going to take your target company and throw it into the ring with its toughest enemies. We will see if it truly deserves your capital. The first step in this process is defining the peer group. This is where many beginners fail. They compare apples to oranges. If you are analyzing Tesla, do you compare it to Ford? Or do you compare it to Google? If you are analyzing Netflix, is its competitor Disney? Or is it YouTube? Defining the peer group correctly is 50% of the work. You want to find companies that sell similar products to similar customers in similar markets. Ideally, pick the top 3 competitors. You need a benchmark. Once you have your peer group, let's say Company A, your target, Company B, and Company C, we build a comparison matrix. We look at 4 specific battlegrounds. Battleground 1, size and market share. Who is the gorilla and who is the monkey? Look at the market capitalization, the total value of the company and their revenue. Is your target, the market leader, the gorilla? The gorilla usually has the scale, the brand, and the stability, but they grow slowly. Or is your target the challenger, the monkey? The challenger is smaller, riskier, but potentially grows much faster as it steals bananas from the gorilla. You need to know which one you are buying. Are you buying safety, or are you buying aggression? Battleground 2, efficiency, the margin war. This is the COO's favorite metric. Look at the operating profit margin, OPM. If Company A has a margin of 10% and Company B has a margin of 20%, stop everything. Why is Company B making twice as much profit on every dollar of sales? This usually means Company B has a stronger moat. Maybe they have a better brand pricing power. Maybe they have better technology cost advantage. Generally, in the long run, the company with the highest profit margins wins. If your target has the lowest margins in the peer group, you must ask, why am I buying the weakest player? Battleground 3, valuation, the price war. Now we compare the price tags. Look at the per-price to earnings ratio of the group. Let's say the industry average PER is 20. Company A is trading at a PER of 30. Company B is trading at a PER of 15. Why is your target Company A so expensive? Is it because they are growing much faster? If yes, the premium might be justified. But if they are growing at the same speed as Company B, but trading at double the price, then Company A is overvalued? You might be better off buying Company B. It is the same car for half the price. This leads to a strategy called pairs trading thinking. Sometimes you start researching Company A, but after doing the competitor analysis, you realize Company B is actually the better investment. Don't be loyal to a ticker symbol. Be loyal to the best opportunity. Battleground 4, growth, velocity. Who is running the fastest? Compare the revenue growth rate and earnings growth rate over the last 3 years. If the industry is growing at 10%, but your company is only growing at 5%, they are losing market share. They are slowly dying. We want to own the company that is growing faster than the peer group average. So, let's synthesize this. You want to find a company that is gaining market share, growth is higher than peers, is more efficient, margins are higher than peers, but is not insanely expensive, valuation is reasonable compared to peers. If you find this combination, you have found a champion. But what if you face a dilemma? What if Company A is growing fast but is very expensive? The growth stock, and Company B is growing slow but is very cheap. The value stock. Which one should you ink buy? Should you pay up for performance or should you hunt for a bargain? This is the eternal philosophical debate of investing. It is the battle between growth and value. In the next episode, we are going to resolve this conflict. We will discuss growth versus value stocks, when to buy what. We will learn how to adjust your strategy based on the economic season. Line up the competitors, compare the numbers. May the best company win. I'll see you in the next video.